Here is the number that should arrest your attention before markets reopen on Monday morning. Over the past 6 months, investors have quietly withdrawn nearly $3.9 billion from the world's largest silver-backed fund. Nearly $4 billion. Gone. And while that exodus was underway, while institutional and retail money was streaming toward the exits, silver itself rose nearly 6.45% in a single week. Money leaving, price rising. If you have been watching the price candle and concluding that everyone sees what you see, that contradiction is the first thing this Monday needs you to understand. Stop right there. Because what you are about to discover in the next few minutes is not what most financial commentators are telling you this weekend. Stay with this. The most important thing happening in the silver market right now is not the rally itself. It is what the rally is concealing. The week that just ended did not begin quietly. On Wednesday, July 1st, Federal Reserve Chairman Kevin Warsh, the man installed specifically to be tougher than his predecessor, the hawk's hawk, the central banker markets had priced as immovable, stood before the European Central Bank's forum in Sintra, Portugal, and said something that landed like a small earthquake in precious metals trading rooms around the world. Warsh said that inflation expectations and inflation risks have come down in recent weeks, while reaffirming the Fed's 2% inflation target. That was not a loud statement. It was not a pivot. But in the compressed, hair-trigger world of rate-sensitive assets, a whisper from a confirmed hawk is louder than a shout from anyone else. Gold heard it immediately. Silver heard it harder. Wait, before you scroll away, the next 60 seconds of this story will change how you read every silver headline for the rest of this year. This is not routine market commentary. This is about a structural fissure that most investors holding silver right now have never been shown. Spot gold rose over 2% to $4,089.49 an ounce, and spot silver added 2.8% to $60.24 per ounce. The following day, the week's defining data point arrived. The latest jobs data showed that the U.S. added 57,000 jobs in June, the lowest in 4 months, and sharply below the market estimate of 110,000. Fed funds futures now indicated a 50% probability of a September rate hike, down from 67% before the latest employment data. By the time Indian bullion markets were recording their weekend snapshots, markets that trade around the clock, indifferent to American holidays, silver had posted a weekly gain approaching 6.45%. The white metal had clawed back from 7-month lows in the span of 4 trading sessions. This is the surface story. It is real. The catalysts were genuine. But the surface story is precisely where most retail investors stop reading, and it is precisely where the real story begins. Here is what the price chart does not tell you. The iShares Silver Trust, ticker SLV, the largest physically backed silver fund on the planet, holding real silver bars in London vaults, has shed over $3.6 billion in assets in 2026. SLV has seen moderate outflows from ETFs, which contrasts sharply with the inflows observed in the SPDR Gold Shares ETF during periods of gold price rallies. Read that carefully. While silver was staging one of its sharpest single-week recoveries in months, the fund that is supposed to capture institutional and retail enthusiasm for silver was hemorrhaging money across every measurable time frame: 5 days, 1 month, 3 months, 6 months. If you have been in this community for any length of time, you know that a rising price candle is not the same thing as a healthy market. The two can coexist. They can also diverge. This week, they diverged dramatically. And understanding why that divergence exists and what it means for Monday's open is the entire purpose of what follows. When authorized participants redeem SLV shares in bulk, the trust does not merely shuffle entries on a spreadsheet. Over time, persistent redemptions can reduce the physical silver actually held in those London vaults. That is not a technicality, that is a mechanism. What the redemption data tells you is that a meaningful portion of the money that flowed into silver earlier this year, the investors who piled in on the way up, who bought the narrative of an industrial revolution in silver, who watched the price climb toward its January high, has been walking toward the exit, calmly and consistently, even as newer money arrived through the futures door, betting on rate cuts. The price can rise on the marginal buyer, while aggregate fund positioning tells a completely different story. Both things are true at once. That is not a data contradiction. It is a market telling you something about itself that most people watching the price chart are not equipped to hear. The honest observer must pause here and acknowledge what this means for anyone who has been reading weekly gains as confirmation of a broad and durable consensus. There is no such consensus. There is a tug of war, and tug of wars in financial markets tend to resolve loudly. Before we go further, and the next part of this story involves a number that the Silver Institute itself has been publishing for months that almost nobody in mainstream financial commentary has connected to what happened this week, hit that subscribe button right now. Not because this channel asks for your loyalty as a courtesy, because what comes next is the piece of this puzzle that changes everything else, and you will not want to miss it when this story moves again. The structural facts underneath this market do not care about weekly price candles. They have been piling up, quietly and relentlessly, for 6 consecutive years. Keep your eyes on this screen. What you are about to hear about the physical silver market is not a theory. It is documented, measured, and published by the Silver Institute, and it has been running in the background of every price move, every ETF redemption, and every futures position opened this week, like a river that does not know or care about the weather above it. It is the 6th consecutive year that global silver demand has exceeded total supply, according to the World Silver Survey 2026. That deficit is widening, even as total demand is expected to fall 2%. The reason? Supply is falling faster. Sit with that arithmetic for a moment. Demand fell, supply fell faster, the gap grew wider. Since 2021, those stocks have been drawn down by 762 million troy ounces, roughly 9 months of global mine output. 6 years, 762 million ounces. The world has been consuming more silver than it produces every single year since 2021, drawing down the reserves accumulated over prior decades to cover the shortfall. This is not a quarterly fluctuation. It is not a narrative. It is basic supply and demand arithmetic applied to a metal that does not come back once it is consumed, in a solar panel, an electric vehicle relay, or a semiconductor. This is the part of the story that the SLV outflow data cannot erase, and the futures positioning data cannot override. The paper world and the physical world are 2 separate conversations. They are connected, eventually, but they can diverge for months, sometimes longer, before the physical reality asserts itself into price. Now layer in what the solar story actually means this year, because it has been widely misread. Silver use in photovoltaics fell 6% in 2020, 5 to 186.6 million ounces, and is forecast to fall a further 19% in 2026 to roughly 151 million ounces, according to Metals Focus and the Silver Institute. At first reading, that sounds catastrophic for the bull case. Solar was supposed to be the engine. If the engine is running on less fuel, why own the fuel? The answer requires understanding what actually happened and why. What is happening is narrower than the headline. Thinner silver loadings per cell, together with somewhat softer installations this year, are pulling demand lower at the same time. But the metal is not being designed out of existence. It is being economized exactly where a high price pushes hardest. Do not move on from this screen yet, because the thing about that solar reduction that almost every commentator has missed is the 4 words that follow it in the Institute's own analysis. Even with that solar reduction fully accounted for, 2026 is on pace for a 6th consecutive annual shortfall of approximately 46.3 million ounces, according to Metals Focus and the Silver Institute. The biggest single industrial buyer of silver reduced its consumption by nearly a fifth, and the physical market is still in deficit. That fact has no precedent in this conversation, and it deserves to stop you cold. The reason it is possible is sitting in the supply side of the ledger, and it is a structural constraint that price alone cannot quickly fix. Around 70% of silver is extracted as a byproduct of mining other metals, primarily copper, zinc, and lead. When silver prices rise, miners do not rush to open silver mines. They open copper mines when copper margins support it. Silver follows. New mine development, from exploration to production, typically takes 7 to 10 years. You cannot accelerate geological time with a price signal. The supply side of this market is, by its nature, slow. The demand side, industrial, monetary, speculative, can move in days. That asymmetry is the structural engine underneath the deficit, and it has been running without interruption since 2021. Now add the futures market picture, because it adds another dimension to this week's story that the ETF data alone cannot capture. Recent commitment of traders data on silver futures shows managed money, the speculative hedge fund and CTA category, building bullish exposure faster than commercial traders are building their hedges on the short side. 2 different types of silver exposure, physically backed fund ownership and futures speculation, are pointing in opposite directions in the same week. The ETF bleeds. The futures book builds long. The physical market runs its 6th consecutive deficit underneath both of them, indifferent to what either category of paper investor decides on any given Tuesday. Consider, too, what the gold-silver ratio is telling you right now, because it is a signal most casual silver watchers glance at and immediately misread. The ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When that number is high, silver is historically cheap relative to gold. When it compresses, silver is catching up, and the catching up tends to happen fast, with the violence of a coiled spring releasing. Silver hit an all-time high above $121 in January of this year. It has since corrected sharply, falling more than 40% from that peak before this week's bounce. Gold, in the same period, held up considerably better. The ratio expanded during that correction. What that means in plain terms is that silver became dramatically cheaper relative to gold over the span of a few months. Cheap in the same ratio compression sense that has historically preceded silver's most explosive moves. The investors who understand this ratio are not looking at this week's 6.45% gain and thinking the trade is over. They are looking at where silver sits relative to gold and thinking the correction may have created the very setup the ratio has signaled before every major silver outperformance in the modern era. That is not a guarantee, it is a historical pattern. And historical patterns in commodities markets carry more weight than any single week's price candle, precisely because they encode the behavior of supply, demand, and human psychology accumulated over decades rather than days. There is also a geopolitical dimension that Indian bullion commentary has been specifically flagging as a support factor for both metals through this week. The US and Iran held technical talks in Doha as they sought to agree on the flow of shipping through the Strait of Hormuz and secure a lasting ceasefire. Iran issued fresh warnings about vessels sticking to designated shipping routes through the Strait of Hormuz, even as actual shipping traffic through the strait has stayed remarkably steady. This is a genuine two-sided setup. If the Doha talks resume cleanly after the current diplomatic pause, and the Hormuz dispute gets resolved, that removes an energy-driven inflation risk that has been quietly supporting metals. If anything goes wrong in the pause window, a vessel testing Iran's designated routes, an incident near the strait, the bid into both gold and silver could be fast and sharp within hours of markets reopening. The honest analyst acknowledges both possibilities with equal weight. The bullish scenario is not more likely merely because it is more comfortable to hold. What the week's data has revealed, in aggregate, is a market that is more complex than any single metric suggests. The price rose, but the ETF bled. The futures built long, and the physical deficit widened. The investor who reads only the price is carrying a map with 3 of its 4 compass points missing. The ones who stay with this through to the end of this analysis will have a more complete picture than most of what they will encounter on financial cable television this weekend. Which brings us to the question that actually matters heading into Monday's open, and it is a harder, more honest question than most silver commentary is willing to ask out loud. One more thing before Monday arrives. One more piece of the picture that will either confirm this week's rally as the beginning of something durable or expose it as what bears will call it. A short squeeze on soft data that will unwind the moment the next inflation print arrives hotter than expected. The difference between those two outcomes is not a matter of opinion. It is a matter of which data points you choose to watch and how honestly you are willing to read them. Start with the bear case, because intellectual honesty demands it be stated clearly before the structural argument is completed. The SLV outflow data covering nearly 6 months and nearly $3.9 billion is not a footnote to explain away. The silver market's meteoric rise in 2025 to 2026 has captivated investors, with prices surging to historic highs above $58 per ounce by December 2025. Yet beneath this veneer of optimism lie significant risks. A fund that has seen 6 consecutive months of net redemptions, totaling that magnitude, is registering a genuine vote of reduced conviction from a large and sophisticated slice of the market. The possibility that this week's price rally is a short squeeze on soft data, rather than the beginning of a durable trend, cannot be dismissed by anyone reasoning carefully. A shift in sentiment triggered by a strong US dollar, rising real yields, or ETF outflows could precipitate sharp corrections. Do not scroll away from this screen now, because what follows is not a sales pitch for any position. It is the honest accounting that separates analysis from noise, and it is the reason this community exists. The Fed's September decision is nowhere near settled. Markets are currently pricing about a 65% probability of a September hike. A hot inflation print or a payroll snapback in the coming weeks could reverse the rate cut optimism that drove this week's gains as rapidly as it arrived. Silver's rate sensitivity is a feature of the bull case when rates are falling. It is an identical feature of the bear case when they are not. The same mechanism that sent silver up 3.85% on Wednesday can send it down 3.85% the morning after a strong jobs report. Anyone who has watched this metal's behavior over the last 18 months does not need to be reminded of that. Silver fell nearly 40% from its January highs on a single hawkish narrative shift earlier this year. The speed of that reversal was not anomalous. It was silver behaving exactly as it always has when the rate trade unwinds. The managed money long build in futures, while bullish on the surface, is precisely the category of speculative positioning that gets unwound fast and hard when data disappoints. The divergence is notable. SLV experienced profit-taking outflows, while PSLV and SIVR attracted capital. This may reflect investor preference for funds perceived to have more direct physical backing. That divergence within the silver investment universe itself, between investors leaving the largest paper-backed vehicle and investors buying into more directly allocated physical vehicles, is itself a story about what sophisticated money thinks about the difference between owning silver and owning a claim on silver. And yet, the structural deficit does not know the future's positioning. It does not read the ETF redemption data. The world is consuming more silver than it produces. It has been doing so for 6 consecutive years. The deficit is widening. 6 consecutive deficits. Irreplaceable industrial demand. The structural case does not require the price to move tomorrow. It requires the deficit to continue, which it has, every year since 2021. The deficit is the thesis. The price is noise. There is one more dimension of this story that deserves its own paragraph before the watch list is assembled, because it speaks to something deeper than weekly flows and COMEX positioning. It speaks to the fundamental question of what kind of asset silver actually is, and why that question is harder to answer correctly than most of its owners realize. Silver is not gold. It is not merely a cheaper version of gold, slower to move and easier to accumulate. It occupies a genuinely unusual position in the global economy, simultaneously a monetary metal held as a store of value against currency debasement, and an industrial commodity consumed permanently in the manufacture of things that power the modern world. Solar panels do not return their silver. Electric vehicle relays do not return their silver. Semiconductor connections do not return their silver. When that silver is used, it is gone. Not recycled at commercial scale, not sitting in a vault available for monetary demand to call upon. The metal that just fueled a global energy transition is the same metal that investors are treating this week as a rate cut speculation vehicle. That dual identity is not a marketing description. It is a structural fact about the market that creates the conditions for both its most violent rallies and its most disorienting corrections. The investor who understands both identities simultaneously, who holds the industrial deficit story and the monetary sensitivity story in the same frame at the same time, is operating with a map that most of the retail money moving through SLV and silver futures this week simply does not have. That is not an elitist observation, it is an invitation. Because the map is available to anyone willing to read it carefully, and this analysis has been attempting to hand it to you for the entirety of this conversation. So what does the careful, honest observer watch into Monday's open and beyond? Watch the SLV flow data specifically over the coming week. A reversal into net inflows while price is still rising would be a genuinely bullish confirmation, the signal that the divergence between paper redemptions and physical deficit is beginning to close from the paper side. Continued outflows during further price strength would mean the split is widening, not healing, and that the resolution, when it comes, will be louder than the setup. Watch whether the Doha talks resume cleanly after the diplomatic pause ends on or around July 9th. Watch what tone comes out of that meeting on the Hormuz shipping dispute specifically, because that dispute is the near-term geopolitical variable with the fastest potential impact on energy prices, inflation expectations, and by extension, the Fed's posture. Watch Kevin Warsh's next public appearance, because a man willing to soften his language once in Sintra can just as easily firm it back up the next time he stands before a microphone, and this market is trading on his words as much as on any hard data point right now. Upcoming major U.S. data includes June ISM services on July 6th, ADP employment change on July 7th, and FOMC minutes from the June 17th meeting on July 8th. Each of those data points carries the potential to move this market materially in either direction. What this week exposed is not silver itself. It exposed the habit, widespread, comfortable, and dangerous, of assuming that a rising price candle automatically means everyone is reading the market the same way and positioned accordingly. This week proved definitively that they are not. Some money left through the ETF door. Different money arrived through the futures door. The physical market underneath both of them kept running its 6th consecutive deficit without acknowledging either arrival or departure. That is 3 separate markets, each telling a different story about the same metal simultaneously. The investor who understands all 3 stories, who reads the SLV redemption data and the COMEX positioning and the Silver Institute's deficit figures as 3 separate but connected conversations rather than one, is holding a fundamentally different picture than the investor who watched the price go up 6.45% and concluded that Monday will simply continue the trend. If this analysis gave you something you had not already connected, if the 3-part picture is clearer now than it was at the beginning of this conversation, then drop a comment telling this community where you are watching from and which of these 3 signals you think matters most heading into the week. The disagreements in the comments section are consistently sharper and more useful than anything on financial cable television. This community was built on the premise that logic over noise and data over drama is not a slogan, it is a method, and the method requires you to bring your honest reading, not your most comfortable one. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.